Hello and welcome back to this week's episode of Companies and Markets Weekly from Stockopedia. I'm Lawrence, I'm your host for today, and I've got a full panel with me today of Graham Neary, Megan Boxall and Roland Head. It was a slow start to the week, news-wise, but yesterday, Thursday, the newswire sprang back into life. So we do have some things to talk about this week. We've got Christmas trading updates from some of the bigger supermarkets and value retailers in the UK. We're going to talk a bit about those and some insights into UK consumer behaviour and how they are adapting to that. We've got a leader in the UK pawnbroking market updating. And we're also going to talk a little bit about some of the takeovers that have happened this week as bigger players keep sweeping up companies that they see as undervalued. We're also going to touch briefly on a reverse merger that you may have missed over the Christmas break. First up, should we start with the value retailers? Megan, Graham, I know you looked at Greggs and B&M or BME this week. What stood out to you there?
Yeah, so I covered B&M with the ticker BME, and it was noteworthy that the shares fell by over 10% on the day, so that was Thursday. Despite the Q3 update seeming to be pretty okay, management were very confident. They even announced a special dividend worth £150 million. But I think the market has really gone cold on value retailers, especially if you think of the likes of Shoe Zone as well. Of course, Shoe Zone is much smaller, but these retailers that are competing on price and where there's a lot of overheads, especially staff overheads, which may increase now. It just seems as if the trend has kind of gone away from value retailers, both in terms of consumer sentiment, perhaps a little bit, but especially the stock market sentiment has really gone against them. In terms of B&M, I was neutral on this one. I don't think. I mean, it was virtually in line this trading update. They narrowed their profit guidance slightly, so there was a slightly negative movement in terms of their profit guidance. But the company is highly leveraged in terms of having a big net debt figure of £800 million almost. Now, the company can probably carry that debt comfortably enough. But personally, I don't see the attraction here. It might be a value retailer and a value share, but growth is fairly limited. And yeah, I mean, I kind of agree with the market, honestly, that I wouldn't be too keen on them even at these levels.
I find it quite interesting, the B&M and what you're saying there about value retail and the fact that we have been for a few years in a period. It's been a period of time where people don't want to spend. They don't want to spend. They can't spend so much. A weaker economy, and yet value retailers seem to be struggling more than higher price. I think it'd be quite interesting next week. Dunelm will have a trading update. It's obviously a direct comparison in the household goods market, but much higher quality, much more expensive than B&M. And I guess it's that concerns about price matter so much more when the differentiating factor for B&M is its price point.
Yeah, and I suppose that a direct comparator would be the range. I have the range fairly near where I live, and personally, I hate the place. But if you want a bargain, it's hard to beat. I wouldn't like to compete against the range, and that's what B&M does.
Yeah, I think one point maybe with B&M is that if you're looking back over the last 5 years or so, the whole pandemic period, there was that they were a really big winner during that period. They were allowed to stay open, all the shops, and they really recorded very strong growth. And now I think that is slowing down. Inevitably, I don't think the growth is going to be as good as it was. And yes, one of the things in the trading statement this week was that like-for-like sales were slightly negative in the run-up to Christmas, so in the quarter up until the end of last year, which was maybe not what people were expecting. But I mean, for me, I'm slightly more positive on it. I think it's much more profitable than the big supermarket chains, for instance, and it does generate a lot of cash. And the question mark for me really is whether they can sustain the number of their store opening program, whether they can keep opening stores and maintain the profitability of the ones they have and of their overall business. But I think at current levels, I'm not quite as negative as maybe you would be, Graham. I'm a little more optimistic, I think.
Is that the growth plan, the opening of new stores?
Yeah, I think the plans for this year is they have about 770 of the core B&M UK stores, and I think they want to open about 45 more this year, they've said. And then they're also opening brand stores under their other fascias, which is Heron Foods in the UK, which is a kind of value convenience store, mini supermarket, and B&M in France, which is a much smaller operation. But they are still opening stores at a fairly significant rate, I suppose, a bit like Greggs in that regard, too.
Yeah, just to clarify, I'm not negative on this. I just think it might be priced about right at a PE multiple of 8 times. You know, if this was trading at 11, 12 times, I would say that would be a bit punchy, given the headwinds, the level of competition, national insurance, and so on. But yeah, maybe at 8 times, I would say this is a fair price for it.
What's Greggs valued at the moment?
Greggs is significantly higher than that. Greggs is a PE ratio of 15, 15 times forecast earnings. Different growth trajectory to B&M. A lot, about 12% compound annual growth rate, but that has come largely from opening new stores rather than growth within the existing stores, which actually fell in the fourth quarter, which is why the share price was down quite significantly this week when the company announced its trading update for the Christmas period. I think, there is that concern, I guess, with a company that's highly rated as Greggs, whether it can continue to grow to justify that kind of rating, which is a relatively high rating for what is really a retailer, a company in the hospitality business, although it does have relatively high margins for a company operating in that sector. It'll be interesting to see when there are more Greggs locations than McDonald's, Burger King, and KFC locations in the UK put together, where it can keep rolling out new stores to.
I'm going to come onto that in a bit, but I just wanted to jump in on the number of stores. This is an anecdote from me over Christmas. My wife and I watched something on Netflix it was something to do with Korean fried chicken. And apparently South Korea has more fried chicken shops than McDonald's has stores worldwide.
That's quite a stat.
Yeah, I thought I was staggered by that. But anyway, Greggs, I think, said that it was still going to continue with its store rollout program, opening more stores. Was there anything else in there about other avenues for them growing?
Well, the other big area for the company is product innovation. So we see things like the vegan sausage roll. That was the big hit from a few years ago. More recently, they've had the festive bake. And there's all sorts of product innovation. And actually, I read Paul wrote about Greggs last time we covered it, and he said that he had been tempted in because he'd seen on the side of the motorway, he'd seen the poster with like something new, and it was that tempted him into Greggs. And I think that is, I think that's true. I think they're able to do very, very good marketing. They're brilliant at marketing. And they're able to do very, very good marketing campaigns around these new products. And it's not necessarily the fact that people will then go and just buy those new products. but they might go in there looking for those new products and then decide that actually I'm going to get my lunch, I'm going to get my breakfast, I'm going to get my coffee from Greggs while I'm here.
And now I've seen people at Parkrun with Greggs branded running gear.
Yeah, so they've got a collaboration with Primark for that kind of stuff. It's been popular. It gets the name out there, and it is a popular name.
It's eye catching as well. Do you have a set Greggs order, or are you one of the people who goes in to try the innovations?
Oh, I have a set Greggs order, and if it's not there, which on 2 occasions over Christmas it wasn't, I was very disappointed. It's a very basic order. I get a chicken and bacon baguette, and the reason that I love Greggs as much as I do is because that chicken and bacon baguette is really good quality. It's not like Pret where it's like 80% mayonnaise. It's a proper, like, you get a good amount of chicken in there, and it's great, and it's so cheap.
How cheap? What do you pay for your set, Greggs?
I rarely pay more than £5, and okay. I am normally getting like sandwich, drink, pastry, maybe some chicken wings.
What would you be willing to pay for that as like a top end?
Yeah, it's an interesting question. I think it's a question that's going to impact Greggs more in the coming months. Greggs employ more than 30,000 people, so they are likely to be hit by they're almost certainly going to be hit by rising national insurance costs. And they said management said this week that they're going to mitigate that increase in costs, which I think translates to increase the price of sandwiches, sausage rolls, and things like that. And as a value, with such a strong value position in the market, I think that is a potentially nerve-wracking place to be, a similar sort of situation that is facing B&M. So I personally am willing to pay slightly more, mainly because my other lunch of choice is M&S, which we are going to come on to talk about in a bit, which is obviously significantly more expensive. But then I work from home. I'm fortunate that I don't have to spend money on lunch very often. When I do it as a treat. So I am probably not the kind of customer that Greggs needs to worry about when they're thinking about raising prices.
Do they also have scope for cost cutting in terms of? I know whenever I've been into a Greggs at like service stations, they're always manned. Certainly compared to like the McDonald's and the Burger Kings that I see at service stations, where all of the ordering is done automated.
Yeah, I think that's I think that's really interesting, because of the 30,000 members of staff, about 24,500 of them are shop workers. And yeah, as you say, there is very little automated ordering in Greggs. And I do think that's potentially an area where there can be some cost cutting. It would be long-term cost cutting, which would come with an upfront, obviously, investment in the technology. There's been nothing said about that, but it's certainly an avenue that the company might start exploring. Also, one that I think speaks to a broader problem around the UK's economic situation. I mean, rising national insurance costs. Yes, okay, maybe we might be starting to fill the government coffers a little bit, which is obviously required. But if it's going to come at a cost to jobs, it's not necessarily going to have the upside that the government needs.
Yeah, I know. Whenever on the tech front, we have a McDonald's just down the road, which we do stop at occasionally. And whenever we go there, they always say, "Did you order via the app today?" They are really, really trying to push the use of their technology, which is, obviously McDonald's has had some other problems in the news recently. My final, I think, thought on the value retailers that I want to get your collective input on is, if I look sort of top down at the metrics for Greggs and B&M, the quality metrics are both relatively similar. Both of them sell, as we've discussed, good value products in terms of the price point. They're both looking to grow via sort of store rollout programs. It's been like a real tale of two charts over the last few years. Greggs has grown and grown and grown. B&M, very much not the case. There's been a lot of talk over the last couple of years with the cost of living crisis about the middle class shopping down. So people who used to shop at certain stores, choosing to shop at other stores. Do you think that that's easier for people to do for Greggs than it is for people to shop down at a place like B&M?
I think it could be possibly. Greggs has got such terrific marketing and branding, and that seems to have a really broad appeal anecdotally from people I know, and surprising people sometimes that you wouldn't necessarily expect. And then there's the other fact, I think food that's ready to eat is often seems to be a much easier sell than quite a lot of other things sometimes. It may also be what they offer. Greggs offering, like Megan said, there's a good mix of things that appeal to people at the right time, at the right place, and that's always been Greggs' real secret, that they're where you want them to be with what you want at the right time. Whereas B&M is a place you do have to go to, and perhaps a lot of what they sell isn't quite is not for timely consumption in the same way, and people might defer it, or they might find it on offer at Sainsbury's or Lidl or wherever. So maybe a little bit, but I think it's partly just timing. That B&M had a stronger phase slightly earlier. Greggs has done very well recently, and now maybe there's a bit of consolidation for both of them with the rising cost base that they've got to address somehow.
Yeah, they're very different companies. Obviously, B&M is a variety store. Greggs is a branded food store where you're getting something that is in some ways unique. It's its own thing. It's like going to KFC. You're getting a particular type of food that you want. I know, anecdotally, I'm in Ireland, and I've been up to Belfast a couple of times in the last few years, and every time I do, I have to import Greggs items back to the Republic in my car every time, because there's someone here who wants Greggs, and I'm the only way they can get their fix is by bringing it in the car down the motorway.
Which items? We've got to know which items.
Well, there's no point asking me, because I don't eat the stuff myself, but I know that the people who do like it, they really, they get hooked on it. So
oh wait, so I thought you were bringing it back for one person. So you are bulk buying Greggs produce and bringing it back in your car boot.
Sort of, yeah. Let's not get into the details, but it's badly needed. So I understand.
Sounds like you're a Greggs mule for the whole of the Republic of Ireland.
There's a need for Greggs that you're not going to get that for B&M. Nobody's going to say, oh, you're going to be up there near, you're going to be near B&M. Get me the such and such. That's never going to happen.
So, are there competitors to Greggs in the Republic of Ireland, or if Greggs management are listening, have we just identified a ripe new market for you to open more stores?
No, I don't think there is. It's the pasties and the bakes. These. I think these are more tied with the north of England. I think that's a particular market there geographically. So no, I don't think there is an opportunity, honestly.
Gotcha. Shall we move on to Christmas trading updates from the supermarkets? Who wants to kick off?
I'm happy to kick off. I just had a quick look at Sainsbury's today, and I also covered Tesco yesterday in the daily stock market report. Obviously, these are similar companies. The most interesting feature of the Christmas updates, I think, is that both companies are very proud of gaining market share. And it seems like they've both been gaining market share for some time. And that is at the expense, as far as I can tell, of Asda and Aldi. So there were, these industry trends, these industry statistics basically say that Asda and Aldi have been losing market share over the last year, while Tesco and Sainsbury's have been gaining it. So it kind of speaks back to what we were saying about, the trend of people trading down might be over, and arguably people are trading back up again. Although Tesco also said that they were gaining market share from the premium supermarkets as well. I don't think Sainsbury's was as specific as that, but certainly seems like the middle ground is finally experiencing strength after having been, weak for a number of years before that. So I'm moderately positive on both of these stocks. I don't get excited about them, but I think if you're looking for income, uh, they are definitely candidates. They are, they're standard blue chips, FTSE 100 stocks that people buy for dividends.
I think what's interesting about both Sainsbury's and Tesco, especially with looking at that, where they're taking market share, is that they both have very good rewards systems. And I mean, the Tesco Club Card in particular, it's certainly price competitive with Aldi if you're using your Club Card. And the same, I guess, with Nectar Points. So I suppose that's where they're in a position that they can take market share at both the bottom and the top, because they can roll out nice premium products, but also offer very competitive prices for those who are regular shoppers.
I saw a clip from a YouTuber who does a lot of analysis of food and nutrition and also the cost of it. And he compiled a list of all of the prices of all the supermarkets, like premium all butter mince pies from 2023, and compared it to 2024. And all of them were around about £2.25 in 2023. And all of them increased by roughly the same amount. It was about 8% to 2024. Apart from Tesco's, their Tesco Finest all butter mince pies, they put that up to £3.50. It was an increase of a whole pound over a £2.50 pack of mince pies, if you weren't paying the club card price. If you were paying the club card price, it was their all butter mince pies went down to £1.75. So undercut all of the other ones by about 50p.
Yeah, I mean, if I'm in Tesco and I forgot the club card, I'm just going home. I'm not going to do it.
Or I'm going to, what I've also noticed is a trend of the budget supermarket, so Lidl and Aldi, opening branches in the same location as one of the more sort of middle ground supermarkets. I live just outside Newport. We've got a big Sainsbury's and a big Tesco's, and both of them within the last year or so have had budget chains open literally next door to them as well. So I wonder if that's playing into that.
Yeah, I think it makes sense, obviously, to do that because vast numbers of people will go to both of them. I mean, I think in our house we use 3 or 4 supermarkets quite regularly. So people are picking and choosing, aren't they? If they have the time to visit, more than one.
Megan, you took a look at Marks and Spencer's this week as well, which is definitely one of the more premium supermarkets.
Yeah, I did, but also doing very, very well on the food side. Non-food side, less well, but Marks and Spencer has been a mixed bag over the last sort of decade, but very, very strong in the last couple of years, really pushing a turnaround strategy which has centered around food. And yeah, the growth in food sales over the Christmas trading period. So the trading update this week was specifically about Christmas. It was about 9% growth year on year, which is amazing. And I also think one of the things that jumped out to me was management saying more people are shopping their whole shopping basket in M&S, which I think in the past was a bit unusual. But I do wonder a little bit if M&S is one of those companies which is benefiting from changing consumer demands, more people looking for eat in rather than eat out. Eating out is very expensive. It's getting so much more expensive. And people are willing to pay £15 for the M&S Gastro Dine-In for Two by Tom Kerridge, rather than spending 50 quid on an equivalent meal in a restaurant. So yeah, I think that's partly behind the trend at M&S. They've got their branding right, they've got their products right, but yeah, market a little bit spooked by the fact that non-food revenue was not so impressive.
What do you think they've got to do to ignite some more growth in the non-food sector?
I mean, it's difficult, and I think this is where M&S becomes not a comparison with the supermarkets, but a comparison with Next, which also had some numbers this week, which Roland covered. Next obviously gets it right, and M&S on the clothing, home and beauty, I think is what the division is called, is less impressive. I don't think they've got a very good digital footprint, M&S, compared to Next. Something that I think management has said they want to work on. Obviously, a lot of shopping is done online now. Footfall was down over the Christmas period in the high street, so yeah, fewer people literally going into shops to buy their clothes. So yeah, Roland, I don't know if you've seen that comparison at all, the Next versus the M&S non-food division.
I don't know if you want to cover this, Graham. I don't think I did look at Next. I think it might have been you.
I heard there was an argument about which one of you got to cover it.
No, I covered Next, and it was another upgrade, as usual, from Next. I should say that I'm a shareholder in Next, have been for years. I mean, there wasn't really a huge amount to say there. It was just more of the same. Not a huge amount of growth. 3.5% growth in full price sales. So yeah, just more of the same there. Small growth, loads of profits, modest, forward guidance. So they're only guiding for another few percent of growth for the new financial year, but hopefully they will beat that. And yeah, the formula is working. Brilliant online shopping, online e-commerce model. So yeah, absolutely no complaints there from me.
On the e-commerce model, I want to dig into that a little bit, because I think what I've noticed at Next doing that I don't think M&S is doing for their online e-commerce operation specifically is buying other brands or licensing other brands purely through their e-commerce division, which I don't think M&S is doing. I don't think Next sells those other brands through their physical stores either. Is that the case?
Yeah, well, the Next has actually been buying up small competitors completely and then plugging them in. So it can plug in other brands without buying them, but it's bought Fatface, Jules, Made.com, Reese, and others, and it just plugs these in and sells them seamlessly online without all the with a much better cost structure than they had before, so they're profitable at Next. So yeah, it has that model that it can just add in new brands very easily and run them profitably.
And I'm assuming M&S isn't giving any clues as to what approach it might be taking to improve its online sales. Is this something that they could do feasibly?
There were comments about it's actually not about online sales, but more digital implementation within the supply chain, which I think is expected to help improve the efficiency, both in both sides of the business. But it's the clothing side that needs a little bit more support. So yeah, more digital integration within the company as a whole, which I assume also will mean a better online offering. Online's only about 33% of revenues in the M&S non-food division, which is quite low compared to other retailers.
Since we're on Next, Megan, do you want to talk about fast retailing as well? Because you had a look at that.
Yeah, just quickly. It's a company that I've looked at on and off for the last few years. Always expensive. It's a Japanese company, owns Uniqlo. That's the biggest brand. It's always a ridiculous price to earnings multiple. It is at the moment. It's trading on 40 times forecast earnings. But the share price performance, even when it's been on these ridiculous multiples, is just consistently extraordinary. It's very interesting reading it. It's quite a different sort of almost cultural approach to reporting compared to Western companies. its chief executive was talking a lot in the full year results, which actually came out last year, about the investment in human development. And I think that's so interesting compared to Western, fashion retailers, which are talking about more digital integration and and as much use of tech as possible. But at Uniqlo, it's the exact opposite to that. But growing unbelievably quickly, both in Japan and internationally. The only place it hasn't grown very quickly in the period under review was in China. China as a whole has been quite a challenging market for anyone operating there, especially the retailers. But I think Uniqlo is a really interesting company. Also, something I'm finding really interesting, obviously having written about it today, Friday, we're getting comments on it saying, I like the products. And I think Uniqlo products seem to really appeal to quite a broad range of people. And because they are trendy, they are fashionable, well, as far as I'm aware. I've got quite a cool younger sister, and she said they're quite cool. But they also, some of the comments today are, they're comfortable, they have pockets, and that is, clearly appealing to lots of people. Not too expensive, but high quality.
I take mild offence at the fact that your insinuation that the four of us are not the arbiters of cool. I have some Uniqlo clothing. I'm currently wearing a Uniqlo base layer, and it's great. It's incredibly comfortable. On the pockets front, I didn't know that you could get wedding dresses with pockets. I'm going to throw that out there. I went to help a friend pick out a wedding dress the other week, and I got very excited about the fact that there were wedding dresses with pockets. There you go. It's a really interesting company, and certainly I know you posted a table of some of the results, and it was incredibly clear, certainly versus a lot of the other.
Yeah, so well laid out, the numbers. It's really nice, but yeah, very expensive, and it's a Japanese company listed. It does have shares listed in the US as well, but they are not that easy to get hold of. So more illustrative than anything else. But it's a company that is worth having a look at.
I want to touch on H&T as well, that reported this week as the UK's leading pawnbroker.
It's funny, we were in the webinar on Wednesday, and I started talking about H&T off the cuff when I was asked what to do about investing in gold, getting exposure to gold. So H&T is the UK's biggest pawnbroker, and it's been doing this for well over 100 years, but the growth rate, I think, is really impressive. You would think that it would be so mature by this stage, but actually its pledge book grew by over 25% over the past year. So it's 10 times the size of Ramsden's, which has the ticker RFX, which is also a quoted company and one that we tend to cover in the report. But H&T, I'm not a shareholder currently, but it was one of my biggest holdings for quite a few years. I eventually sold out because return on capital was kind of weak. So effectively, you could think of it as a type of bank, and it just didn't really get enough sort of quality growth to keep me interested long term. I was in it long term, but I eventually sold out. And over the past 5 years, the shares have really done nothing. Like the share price today is about £3.50. You go back 5 years ago, it was about £3.50. So the shares have done nothing except pay a dividend over this time. But I am interested in it now because during the past 5 years, it has actually grown, and it's now trading at a PE multiple of 6.5 times, according to the stock report. So, I was happy enough to be on the sidelines. I've always liked the company, but I think now it might start to look interesting again. The trading update that came out on Thursday, there was nothing wrong with it whatsoever. The only issue is it has the national insurance problem that every company with a lot of staff is facing. but its estimates are unchanged because with the pledge book growing so quickly, it's thought that higher profits from lending is going to offset the higher expense from national insurance. So, I'm very interested in this one. Part of me regrets not putting it on my watch list or considering it more strongly for my 2025 watch list. But anyway, I've said it now. I like H&T.
Megan, Roland, have either of you ever looked at H&T as an investment?
I have. I actually went and visited. I actually don't know if the founder is still not the founder. The chief executive can't be the founder. The chief executive is who I met is still involved. He was great. I went and met him. He showed me around their head office and one of their shops on the high street. I think it was one of the earlier ones. It's a really nice little business. And as Graham said, Ramsden's is the other listed pawnbroker in the UK. It's not really a fair comparison. Ramsden's is reporting numbers next week. And and H&T is just growing significantly better, significantly larger pledge book. And is a really nice business. I haven't looked at it for a while, but when I did, it's one of the good eggs, I think, on the UK market.
I want to briefly go into the whole pledge book thing. This is not a sector I've looked into much at all. And when I saw the phrase pledge book, it took me a while to figure out what was going on there. Can you briefly explain how pawnbrokers make money and why the pledge book is important?
Yeah, so pawnbroking is one of the most responsible, or you could say reasonable forms of lending when it comes to small amounts at high rates. So over the past few years, payday loans have been cracked down upon. There's been a lot of regulatory work done in the sector, but pawnbroking has come through really virtually unscathed, because the way it works is somebody brings in an item. It could be a piece of jewelry or a watch, and they get a loan. And one of the most important features is that it doesn't affect their credit rating. Their personal credit rating is not relevant to the loan because the loan is secured on the item. So the company will not lend out the full value of the item in the loan. Now, the loan will charge a high rate. So just going off memory, I think it was 9% a month or something when I checked. That was a few years ago. It's a very high rate loan. But the person who has borrowed it can simply choose to not pay it, and there will be no repercussions back on them, except they won't get the item back. The pawnbroker may sell the item, but the pawnbroker may then they will then have to give back the person any surplus from that sale. So it's a very responsible form of lending, a safe form of lending for the lender and in many ways for the borrower. It's been around for over 100 years at this particular company, and it's obviously been around for hundreds of years in Europe before that. So, it's a good business model, and it does charge high rates. So, with H&T having a £127 million pledge book, they can earn massive interest on that, and I think the risk is pretty low. The only big problem is if the gold price, for example, was to fall by 50% suddenly, then there would be issues. There would, so pawnbrokers have to be careful about their exposure, and pawnbrokers can go bust if they aren't careful enough. But that's the main risk.
And what on the gold front, you said that in the webinar we did on Wednesday, I will include a link to the replay in the episode description. You said that you were looking at H&T as a way of getting exposure to gold. I wonder if and maybe the three of you can chat about this. What are the various pros and cons of gold exposure via a pawnbroker versus owning miners, direct exposure via like something like a gold-focused ETF, or just buying bullion directly?
I mean, for me, I would much rather get exposure to gold indirectly through a business like H&T, or possibly through a miner that's focused on on production and pays dividends and has a record of returning value to shareholders, because the idea of investing in gold, for me, investing directly in gold, you're obviously investing in an asset that it doesn't grow, it doesn't yield anything. You're just speculating that the spot price may rise or fall. So as an investment, gaining exposure through a business that should make money from gold, even if the gold price isn't rising, is a much more appealing prospect. So certainly H&T would probably be a good example of something I might consider as a way of getting exposure to gold, I think.
I think we also wanted to touch on takeovers, because there was one you may have missed over Christmas, and then we've had 3 today. So should we start with the one over Christmas?
Yeah, so the situation over Christmas is maybe a little bit different to what's happening more broadly in the UK market. I think takeovers are a big topic in the UK at the moment because the UK is cheap and foreign investors are noticing that. So offering premiums, what look like very large premiums, but actually not particularly big premiums to the underlying value of the equity in a lot of cases. But over Christmas, a slightly more specific and niche example of, I would say AIM being used quite badly. This is a company that was spun out of another company which had its own issues, a company called Poolbeg Pharma, which was spun out of hVivo, which used to be called Open Orphan. The company's founder and chief executive, who is actually the chairman at Poolbeg, he's called Cathal Friel. He is quite a serial moneymaker on AIM. He's an expert in the healthcare division, and I think there are, for me, one too many cases of these sort of small, not making any money, no immediate opportunity to make any money companies literally listing on the market for the capital and then never really rewarding the shareholders who support them. And I think now this takeover is happening. It's a reverse merger into a Nasdaq listed company where there is a lot more capital available, and that's where Poolbeg Pharma is going to end up. And AIM investors are being somewhat left as a bit of an afterthought in this situation. And so, I don't love that is the situation that's revolved around Poolbeg. A lot of the investors were given their shares anyway when the company was spun out of hVivo, but it's still I don't think it's a great look, and I think we need to do more for companies that are really going to reward the UK investors who back them. But today, one announced today, actually also in the healthcare space, and one that's in our NAPS portfolio. So Ed was quite excited. It was a bit of an early win for the NAPS portfolio. Graham, I know you looked at Alliance Pharma.
Yeah, now Alliance Pharma is not a company that I really ever studied much before, but it came up obviously today with the takeover offer. It was a 40% premium or 41% premium to yesterday's close, so a pretty reasonable premium. The buyer is actually the largest shareholder, who is DBay Advisors from the Isle of Man. So they are basically just trying to buy the rest of the company that they don't already own. So it's not like, it's a little bit different to when we get, the US or other sort of foreign takeover of a UK stock. This is more like just going private with the largest shareholder saying, we think this company can do better privately. and offering to buy out its other, its fellow investors. Slater Investments is on this shareholder list. I presume that DBay would not have, taken this action if they had not already, asked Slater if Slater was going to, agree to it. So on that basis, I sort of presume that this will go ahead. Company's trading at 9 times earnings. It's had a bit of a patchy few years, so maybe DBay advisors can see that it's turned a corner, and that the future is bright. One sort of slightly disappointing element of it was where DBay said that Alliance Pharma needed time away from the public market. They said that the listing was a potential distraction for management. So kind of, criticizing the whole concept of being listed. Alliance Pharma has a market cap of it's £330 million today. Okay, it wasn't that as high as that yesterday, but you would think that these small caps would have, there'd be some point to them being listed for the liquidity. I don't get nervous about delisting risk in general unless the market cap is a lot lower than that, because a lot of 200, 300 million pound companies are listed for the liquidity. So I don't know. I thought it was a little bit of a disappointment the way they criticized the whole concept of being listed on the stock market. DBay said that Alliance needed to make certain investments that they would be better able to make without being in the glare of the public eye. So maybe that's true, but I think overall this is kind of a negative news story, because Alliance Pharma seems like a pretty decent company, and I guess we're losing another decent company to take over.
Yeah, looking at what DBay said, I think one wonder whether the subtext is that they may think about Alliance Pharma returning to the market at some point in the kind of middle future, because as you say, it does have quite a long and decent record, but arguably from a long-term perspective, I suppose some long-term shareholders will be possibly quite a long way down on the price they paid, and it may look like it's just being taken out at a relatively cheap valuation during a difficult period, so that the private owner can profit from that and return it to the market at some point. I suppose such is life. But as you say, it seems a little bit disappointing in a way that a company of this size couldn't make it work as a public company, or didn't want to, perhaps. I don't know.
And finally, to finish up, what was the bit of news that got you most excited this week? What was your favourite thing to write about?
I always like writing about Greggs. I think it's just a really nice business. So yeah, I think that was having a look at that was probably my highlight of business week. A good company, and hopefully it can continue to grow, because I think it's one of the good ones that we have on the stock market. And the more we can help keep supporting companies like that, the more I think we can encourage more people to be excited by the UK markets.
Yeah, I suppose from my point of view, the H&T story was exciting. To have a company that's over 100 years old in a very mature financial service kind of sector, and growing at 25% in terms of its main product. I think that's pretty amazing. I should add as a disclaimer that that wasn't purely organic growth. A little bit of that growth, about 6%, was from an acquisition that the company made, where they're making higher value loans to people who may use them for business purposes. But most of that growth was still organic, and I think that's impressive.
Yeah, I think one interesting thing for me, or that's prompted me maybe to think about the market conditions a bit more was discussing whether the outlook for value, whether retailers is changing because of people's changing behavior elsewhere. So, Marks and Spencer's food has been doing very well for a long time. And whether that's benefiting, like Megan suggested, from people who are, people staying in, whether there's an implication for B&M that and for other value retailers that isn't fully apparent yet. I don't know. But looking at, I've been a fan of B&M for a while. I don't own the shares, but I have been positive about the business. So I think this week has prompted me to think about it in a little bit more detail than I have done for a while. So that's interesting.
And that just about brings us to the end of this week's episode. If this is your first time listening, welcome. We'd love it if you hit the subscribe or follow button wherever you are listening. That means that new episodes will drop automatically into your feed every Friday afternoon. If you've enjoyed this episode as well, we'd really appreciate you leaving a positive review or rating on your podcast platform of choice. It really helps us. I've been Lawrence. I've been your host for this week. Thank you very much for listening, and we'll see you next week.